we're delighted to welcome Kip Noble and Kaylee Graham from Capitalise this morning. I'll hand over to them shortly. For those of you who haven't met me before, virtually at least, my name is Paul Whitney. I'm the Managing Director of Hallidays and also lead the corporate finance team, which closely links with our funding side of the business and our funding offering for clients. We focus, for those of you who know our firm, on growth and support. Throughout the COVID period, which is a very, very challenging and strange period for all of us, we have sort of reversed that into a support and growth mechanism for our clients, because we've done a lot of work on cash flows, structures, looking at business viability in COVID and beyond it, because our feeling is that as we exit from the lockdown period, many businesses will need to change direction, maybe change their business model. Some are thriving within the COVID period, but many are experiencing some difficulties. A big part of today's presentation will be around the CBIL bounce back loan offering, but we'll also go into some detail, or at least Capitalise will, on all funding options available to businesses. Just running through what our agenda is for this morning. Quick intro from me. Welcome and update on CBILs and BBLs. That'll be done by Kip. Kaylee's going to give a quick intro to Capitalise first. Then we're going to talk about other ranges of funding available. Going to go into a few aspects of funding in a bit more detail: property, invoice finance, merchant cash, some of the more overlooked finance options within businesses. Then I'm going to talk briefly for 5 minutes on our Hallidays corporate finance offering and how that links into funding, how we work with our clients in that area. And then we're going to go into a Q&A session at the end. Now, in terms of our partnership with Capitalise, we for many years have had direct relationships with lenders and some very successful relationships with brokers to find the best finance offering for our clients. However, coming across the Capitalise platform has meant that we have instant access to 100+ lenders, and their platform actually matches automatically clients to appropriate funding sources. So it's essentially an intelligent matching platform. Not only has it saved us time, but it's also saved our clients time. Quite often funding needs are instant. We like to plan for funding, as I alluded to earlier with the cash flow planning that we've been doing with clients through the COVID period. But sometimes there is an immediate need for a particular purpose, and I'll allude to some of that stuff when we talk through the corporate finance offering a little bit later on. So without further ado, if I can hand over to Kaylee to give a bit of an intro to Capitalise, please.
Amazing, thanks Paul, and good morning everyone. So as Paul said there, essentially we are an advisor-led funding platform, and we have got access to over 100 lenders. But ultimately, the kind of point of what we do is really around partnering with Hallidays to support all of you in making sure that you are getting the right debt at the right time from the right providers. And actually, we completely appreciate that the funding market can be quite complicated and that there's a lot of different providers and products out there. And so actually, through partnering with us, you will be 4 times more likely to get funding. And that is purely because of the amount of education and support that Hallidays can provide you around preparing that information, planning, and then actually coming through our platform and making those smart decisions about the lenders that you then choose to work with. So as Paul said, there's a lot going on in the funding market right now that Kip's going to dive into, but ultimately this session is really about just giving you some more information and letting you know about some of the options available to you.
Thanks, Kaylee. Thanks so much, Paul, for having us, and thanks everyone for joining this morning. So I head up the lender relations for Capitalise. So my role is to look after the relationship with all of our lenders, ensure we've got good connections, good contacts with all 100+ lenders to ensure we can get you, the client, the debt funding you need as quickly as possible on the best terms to sort of obviously suit your needs, obviously through Hallidays. So what I'm going to talk through today is a bit of an overview of sort of the background of CBILs, how we sort of gone through this crisis, how we're looking to recover, and hopefully the products we can utilise and move forward. So if we try and sort of look back, I know obviously Paul and Kaylee both mentioned it, it's been an exceptionally difficult time for a lot of people, and it feels like we've been in this situation forever. It's actually only been less than 6 months since we went into lockdown. So if we can look back to sort of January, February period, the economy was relatively stable. We had a very open lender market. There were actually over 350 active lenders in the marketplace, with generally speaking about 1 or 2 new lenders coming on every single month. It was a hugely competitive, open marketplace, and really we didn't think it was going to stop. Clearly, everything changed very, very dramatically come the 23rd of March. We entered lockdown, and obviously everything's changed since, both socially, politically and economically. I will talk about that in terms of the lending marketplace. So at that point in time, basically lenders really do not like uncertainty. It makes it very difficult for them to price risk into the market and for them to lend accurately against a set client. So lenders tended to retrench. So from those 365 lenders, 75% plus virtually exited the marketplace. It is that impactful. They have to look after their own back book. They have to ensure sort of, default rates don't go up, and they have to ensure basically they, as businesses themselves, can actually survive as well during this period. So clearly at that point in time, the government had to step in to ensure sort of liquidity was provided into the marketplace. So on the 23rd of March, they came up with a scheme called CBILS. As I'm sure a lot of you are aware, it has changed slightly over the sort of timeframes that we've been looking at. But at the moment, CBILS, we've got about 104 lenders that are active in the marketplace. It's debt from 50,000 up to 5 million. It's important to note with CBILS that it does end on the 30th of September. There has been a slight change in that if you have an application in by the 30th of September, lenders now have until the end of November to actually draw down the funds. But it's really, really important if you're considering looking for a CBILS that you apply now rather than later. We're already seeing it within Capitalise in the marketplace, a sudden rush for lenders and for clients and everyone else to sort of really push and get that final sort of debt out in the marketplace. The penetration in the market within CBILS has been actually exceptionally low. You'll see the success rates in the next slide in terms of the actual program itself, but within CBILS itself, there really hasn't been a huge amount of debt that's been provided in comparison to the rest of them. So just a bit of an overview then of how you can get CBILS and what lenders and things like that. So the key caveat with CBILS is that you're allowed debt up to 25% of your 2019 turnover. You must be a viable business. There's a little bit of a disconnect probably between what a lot of clients think of is viable and what lenders think of is viable. Viable, generally speaking, is a profit-making business. And when we talk about profit, we mean profit after sort of dividends and all directors' drawings and all debt that might already be within the business. You can have CBILS across all product types. So you can have CBILS within invoice finance. Generally speaking, if you already have invoice finance, you can speak to your existing lender and potentially get what's called a top up. So if you've got maybe a drawdown rate at the moment of 80, 85%, they might be able to top that up to 100. You can have it across asset finance, so both new or refinance or equity release. You can have it across term loans, revolving credit facilities, which is commonly known as overdrafts, as well as secured. I will caveat with secured that there were only a couple of lenders who managed to get into that marketplace, and they did exit quite quickly because basically everyone's got a debt allocation, and unfortunately theirs was filled up very, very quickly. You can have multiple CBILS across multiple lenders, and as I'm sure most of you are aware, there is no PG whatsoever for debt under 250,000, and obviously it's backed up by that 80% government back guarantee. It's important to note again that guarantee is for the lender. You as the client will always remain 100% liable for that. So yeah, those are sort of the key points to note within CBILS. Another sort of point which some of you might be aware of was changes to what's called business in difficulty. That came into play on the 1st of August. And what that meant is previously some businesses whereby they might have been historically loss-making, they might have a negative balance sheet, were excluded because they counted as or classified as business in difficulty. Those now can actually apply for funding as long as it is still a viable business, so reasonably profit-making in the last sort of year. That came into effect on the 1st of August. But like I say, it's really important to have a look at this sort of scheme. It's a once-in-a-lifetime scheme. The rates are incredibly cheap. All arrangement fees, all interest, all costs for the first 12 months are paid for by the government. Nothing like this has ever come across in our lifetime, and it is really important that everyone looks into it in as much detail as possible. Speak to Halliday, see how they can work with you, maybe do some cash flow forecasting to see if you've got any funding gaps that need filling, because we are going to be retrading up post-COVID, and it's important to look to how we're going to do that, and ensure that you've got the right funding in place. And if you do need funding, or it's, or anything, quite frankly, CBILS is simply the way to go. It's a phenomenal product that the government's put in place, and it's really important that it's utilised, to the best of its ability. And then also within this sort of frame, we also have bounce back loans. The sort of rationale for bounce back loans, I'm sure if we can all remember, clearly when CBILS first came into play, it was just the classic high street banks that were lending. They weren't lending fast enough. These are big juggernaut banks with massive balance sheets. Very, very hard for them to suddenly bring in a brand new product, completely change their process and get debt out quickly. I mean, considering the crisis we were in, the economy had basically been shut down. Businesses were shut down. We had creditors' bills to pay. It needed funding as urgently as possible. That's why bounce back loans came in. And the key difference with bounce back loans is that there was no underwriting whatsoever needed by these lenders. It's up to 50,000, incredibly cheap rates, as you can see at the fixed 2.5%, and it had the 100% government-backed guarantee. So that meant that lenders, like I say, they didn't have to underwrite whatsoever. It was just a self-declaration by the directors, and as you'll see in a minute, the numbers that have been produced from bounce back loans are quite staggering, and they have ultimately changed the lending landscape for this year quite dramatically, and provided huge amounts of liquidity into the marketplace. Bounce back loans don't actually stop until the end of November, so there is still time to apply. But bounce back loans can be relatively restrictive, so you're only allowed one per ultimate ownership group, and clearly with the self-declaration by directors, you need to be really cautious about what you're actually signing away, because you need to make sure that you are signing to say that every single bit within that declaration you are complying with, so the use of the funds, all sorts of aspects like that. So important to sort of go through that. And then obviously as we sort of move out of this crisis and recovery, clearly the government has put into place a huge amount of sort of incentives to really help this recovery. I mean, some of the stats that have come out in the marketplace, out of all the G7s, the OECD 37, we are the worst performing economy in terms of the deepest recession. And that is why the government really has reacted in terms of putting in place what they have in terms of sort of VAT, stamp duty, Eat Out to help out. And I'm sure there will be other schemes that will come through. So as we move through, we'll be discussing sort of the commercial lenders in the marketplace and the products and funding to sort of help us drive that growth as we try and regrow post-COVID into the sort of new normal, as we like to call it. So these are the sort of stats and figures of the actual scheme itself. So as you can see, I mean, some of these figures are absolutely staggering. The normal sort of SME marketplace in terms of debt that's provided within one calendar year in terms of new debt is about 30 to 35 billion, and that's in a full calendar year. This is purely the government schemes, and this is only within 4 to 5 months that this has been provided. It is a huge amount of debt. Clearly, with the government guarantees that have been put in place, there's lots of things in the marketplace in terms of how is this going to affect the economy moving forward, what the success rate's going to be, are there going to be a huge amount of defaults, how is it going to impact things later on. Obviously, that's something that government and lenders are going to have to consider, but it was just so vitally important that money came into the marketplace to help people survive. But it's also important to sort of understand these schemes and this debt as a means, as a sort of sticking plaster as such, to sort of help you survive during this period. It's not really designed to sort of really boost you out into sort of the recovery, to sort of really help in that marketplace. So it is really, really important that that we look at the new commercial products to sort of see how we can regrow post sort of COVID as we enter this recovery phase. Just going to go over the different products that are available in the marketplace. As Capitalise and as Kaylee said, we have the entire marketplace. Obviously, pre-COVID, it was very, very different, but we still have that full marketplace. And I'll just go over now how it's sort of changed in terms of the lenders, the availability, and what you can expect in terms of the marketplace moving forward. So we'll start with trade finance. Now, this has been impacted hugely. So this is to do with sort of import, export, supply finance, and everything in between. And, you know, as I'm sure you can sort of appreciate, given everything that's happened within the global trade market, it has been impacted probably more than any other marketplace. It virtually has stalled. You can get some import-export debt, but generally speaking, if you do have a relatively complex supply chain and you're going in between continents, it is still a very difficult product at the moment to get basically. I mean, as sort of COVID spreads around the world, different countries are obviously going into quarantine at different stages. It's very hard to get a sort of sustainable and consistent approach across the sort of marketplace. So unfortunately, for those international businesses who do rely on sort of supply chain, import, export, unfortunately trade finance at this time is still quite difficult. We're going to go into a bit more in depth, as Paul said, in terms of merchant cash advance, invoice finance and property. So we'll talk about that in a bit. In terms of working capital finance, this historically was sort of the IWOCAs, the funding circles, the ESMEs of this world, who used to provide sort of up to 250, some up to sort of 500,000 of what's classified as unsecured debt to businesses to sort of, you know, help them with working capital, growth, whatever it might have been. Now, this has always been dominated by personal guarantee funding, and obviously over the last sort of 4 or 5 months, everyone's been very used to having that sort of 250k limit where personal guarantees weren't put in place. So it's important that as we sort of look to move forward, if clients and businesses do need debt, that we get back into that mindset that personal guarantees are going to be needed again moving forward as we move back into that sort of new normality. Clearly there is actually a personal guarantee insurance provider out there in the marketplace to help, but it is something that clients are going to need to sort of get comfortable again with providing these personal guarantees to obviously, you know, support growth within their business. Then we're looking at sort of asset finance. This again was very much impacted during COVID. Manufacturers were closed down. Again, the sort of supply chain, because a lot of asset finance purchases, you know, are imported and exported. So this had a huge impact while everything was sort of, you know, shut down during COVID. However, what we have seen is quite a lot of pent-up demand for asset finance. The marketplace is reopened. Manufacturers and businesses are now sort of trading, you know, historically maybe not up to where they were before COVID, but they're certainly trading at a decent level again. So we have seen that pent-up demand. So we've seen flow come in terms of people basically buying equipment in order to obviously help them regrow post-COVID. Again, with most of these products, they're all available at the moment through CBILS, so it's really important to have a look now. This really is sort of the last opportunity to be able to have these products, have the funding that the business needs to regrow, and have it within the CBILS scheme, which is always going to be cheaper than moving forward. You're quite often not going to have to provide personal guarantees, no security whatsoever. So it's really important to sort of have a real look at how you're looking to regrow. Like I said, you know, sit down with holidays, do some forecasting, do some business planning, and see how that is going to happen. And if you do need equipment, if you do need working capital, property finance, whatever it might be, use the schemes that have been put in place by the government to help you move forward. We're going to have a little bit of a deep dive into some of the products at the moment. So if you can move on to the first slide, we're going to talk about property. So why property? Generally speaking, lenders at the moment, they are overexposed to what's classified as sort of unsecured debt. They will classify these CBILS bounce back loans as unsecured. Despite the government-backed guarantee, it very much will be an unsecured product. 80% as a guarantee is not enough. If they had a 20% default rate, most businesses and banks would go bust. You've also got to appreciate the lenders under these schemes will have to go through the full recoveries process before the government will actually repay that debt. And there's always going to be a question mark when it comes to government guarantees. Are they actually going to repay that debt? Because, you know, at the end of the day, they've still got to prove that it was a viable business. They've got to show that they did everything responsibly. And at that point, the government then will most likely repay it, but there is always a question mark in the lenders' minds as to whether they're actually going to get their debt back. So this is why we see property and secured debt in particular as a really good driver moving forward. So we're going to go over three of the products: bridging, commercial and buy-to-let. I won't mention development in great detail, because development is again one that a lot of lenders have been overexposed to, because during this period of the last sort of 3-4 months, a lot of developments were put on hold and a lot of developments have gone under. So lenders have obviously been overexposed. They've been hit quite hard from those, and there are a lot of speaking to a lot of those lenders in the marketplace, they have put that on pause because of the sort of default rates that they've been seeing. That's not to say that there aren't lenders out there in the marketplace that will help, but it's important just to, if you are looking at sort of development, to bear in mind that you're generally speaking going to need a lot more cash into deals moving forward. So bridging loans are sort of relatively similar to development. There's sort of short-term property finance needed when you're looking basically to release cash to buy property at auctions. Maybe you've got the right to buy, but you've only got a few weeks to buy it. Bridging finance allows you to buy a property within sort of a 2 to 3 week time frame, without the sort of need to go through the full legals, the full charges, everything like that within the property market. So it can be a really good opportunity right now if there are any quick purchases in the marketplace, or potentially you're looking to release cash into a trading business, and you need to do it within 2-3 weeks rather than the sort of 3 to 4 months that would normally take for a full first charge. It can be a really, really good opportunity. And again, I'll mention it within the development side of things. Clearly, as developments have sort of been elongated and things have gone wrong with a lot of them, bridging finance has enabled lenders to be refinanced, and it can basically provide debt for another 12-18 months to allow people to sell properties. But in terms of sort of how it works, generally speaking, you'll get loan to values up to sort of 60-65% net. What we mean by net is prior to any sort of rolled up interest. So how it works is you won't pay any monthly interest on these products. At the end of the term, the interest is rolled up and you will pay all the debt back, including that interest at point of maturity. Generally speaking, you're looking at rates of sort of 0.5 to 1% a month, arrangement fees of about 1 to 2%, and terms of 12 to 18 months in general. It can be a really good product if you need that sort of quick financing. So commercial mortgages are very much the bread and butter of the property world, very similar to how lenders treat residential mortgages. Really, really competitive marketplace dominated by the high street lenders. They're very much still open for business. They are slower than they were previously. It's important to understand that. They are very much inundated by the CBILS scheme, the bounce back loan schemes, but they are still open for business. They are still doing 70-75% loan to value. The rates are exceptionally cheap in the marketplace at the moment. So if you are looking to buy a commercial premise, you are looking to buy a secondary premise, now is a really good opportunity, because like I say, the rates are hugely competitive. There are a few new commercial mortgage lenders that have come into the marketplace that we're also now working with. So yeah, it's still an excellent product, and it's one that lenders are very much happy to still lend to. It's the lowest risk property lending out there. So yeah, now is a really good opportunity for that. Buy-to-lets. Buy-to-lets was hit quite dramatically during the COVID marketplace. Clearly, it's very much reliant on valuations. So professional valuations were stopped. Clearly, they weren't able to go out, so only desktop valuations could take place. So loan to values, which typically were between 70 and 80% historically, dropped down quite dramatically to sort of 50-55%. However, clearly, as the marketplace has opened up, valuations have been allowed. We've got back up to where we were pre-COVID very quickly, if I'm honest. The rates are still quite competitive. Generally speaking, 75% loan to value is quite good, but we have seen a huge increase in the number of buy-to-lets that we're seeing coming through. We're also seeing quite a lot of refinances coming through. And just to clarify again why, the the rates, because of the Bank of England base rate going down to 0.1%, the rates that lenders are now charging, especially high street banks, albeit their loan to values are quite low at sort of 40-50% generally because of how they worked with serviceability, their rates are stunningly cheap. Some of them are sort of around the 2% mark, which is phenomenal in this marketplace right now. So if you do have buy-to-lets out there, you are looking around that sort of 40-50% mark, now is a really good time to have a look to refinance, or if you're looking for sort of new purchases, it very much is now an open marketplace, and there should really be nothing sort of holding you back as there were sort of during COVID. So yeah, good opportunity for the buy-to-let market. We're going to talk about invoice finance now briefly. Again, why for invoice finance? We see this as the fundamental product to help B2B businesses sort of move forward. That's ones that work sort of exclusively with other businesses. So ones that have got what's called trade debtors in place. We see this as being hugely important because as businesses regrow up to pre-COVID levels, they are absorbing a huge amount of working capital. And how is that going to be funded? Again, the CBIL scheme, we think, is just going to be a bit of a sticking plaster. I do not think it's going to be enough to help businesses regrow from 10 to 20% trading levels back up to 100. You will absorb a huge amount of working capital, and it's really, really important to forecast, understand how that's going to be funded, and ensure you've got it in place. Now is a great opportunity because invoice finance can be funded through CBILs, and it is completely free, both on a selective basis, full debtor basis. For the first 12 months, invoice finance is entirely free. And considering one of the sticking points for invoice finance is cost, it now is just a phenomenal opportunity to have a look into it. And if it's something that doesn't work out, it can be repaid within 12 months at no cost whatsoever. So really important to understand. If you are a B2B business, you are regrowing, invoice finance is a great product. And generally speaking, it's across two key products. So you've got invoice discounting and invoice factoring. There is also selective invoice discounting, which is where you can invoice individual debtors. And there is also construction invoice discounting, which looks at sort of stage payments and other products of the like. Yeah, so invoice factoring, generally speaking, it's used for the smaller end businesses, ones that might not have full sort of bookkeeping, credit control and things like that in place, because the key point here with the invoice factoring is that credit control is moved from yourself as the client to the actual lender. So they will manage the full credit control, they will chase debtors and the like. It is therefore a little bit more expensive than the other product of invoice discounting, which again is identical apart from the credit control aspect. Generally speaking, you can, once you raise an invoice, the lender will pay up to sort of 95% of the value of that invoice same day. Then it will be repaid on normal debtor terms minus obviously the lender fees. It's always important when looking at this marketplace to get a good few quotes, because it can be a little bit opaque sometimes in terms of how they charge, but it is a really good product at the moment, and we do think it's going to be fundamental to help us regrow at a much quicker rate in the marketplace rather than just organically. And you can also, we've seen clients take advantage of this marketplace, use invoice finance for acquisitions to release a lot of cash and really help grow them. So yeah, I do think it's going to be a really important product. And as you can see, I mean, there are a few pros and cons, but overall we do think, like I say, it should be something to consider, especially now under the CBIL scheme. Like I say, invoice discounting, the same as invoice factoring, generally speaking, for those more professional businesses, large scale businesses that have good credit control already in place, they don't need to sort of pass that on. You can have confidential invoice discounting, which is also important to note, whereby the clients themselves will not know you have an invoice finance lender in place. Everything is still branded as your own business. They won't chase, but obviously you will still get the same benefits of having that cash up front from the invoice. So important to have a look at those products. Obviously speak to Hallidays if you are a B2B business and you are looking to sort of regrow. Now is a great time to have a look. So lastly, we're going to talk about merchant cash advance. This is dominated by the retail, leisure, hospitality sector. It's one that's always historically overlooked in the marketplace because generally speaking, those sort of clients don't have a lot of assets to sort of leverage. So they generally speaking don't hold the freehold property. They don't have trade debtors because they're not really business to business unless they're wholesale. And they also don't really own much stock and other aspects that they can use to leverage. So merchant cash advance is an American style product that's come across to the UK and Europe in the last sort of 2 to 3 years. And it's a way of releasing cash into your business based on the card turnover through the actual terminal itself. So generally speaking, you can borrow between sort of 1 to 2 times your monthly card turnover, and it's completely unsecured. You don't need any tangible security whatsoever. I mean, you will need the personal guarantees, as we touched on previously, but it's a really good way of releasing quick cash into the business. And why we say it's important at the moment is because retail, leisure, hospitality, generally speaking, October, November time is when there's the biggest cash outlay for stock. So it's important, again, if you work in those sectors, to forecast, plan. If you do need funding, merchant cash advance can be a really good product. It's priced very similar to overdrafts, revolving credit facilities. It's certainly cheaper than what the personal overdraft rates are at the moment, are sort of 50%. So again, it's a good product to have a look at and can be really good to help manage those working capitals payments. The pros, so how it works in terms of the repayment, it's done by what's called a sweep. So you'll have funding that will come directly obviously into your business through the merchant card provider. It'll then be repaid via a percentage of each card payment. So it's entirely up to you how quickly you want to repay it, via how steep you want that sweep to be to repay the debt. And again, because of how it works, it's incredibly flexible. So if you don't have any income, if you're a very seasonal business and you don't have income for a couple of months, then you won't have any repayments. And if you have a very busy few months, the repayments will be a lot quicker. So it's a very flexible product to help in that sort of retail, leisure and hospitality sector. So again, something to have a look into if you do feel you need finance and you need more cash than what's been made available under the schemes. Yeah, so thanks very much. Over to you then, Paul.
Thanks, Kip. Some great insights there into the different funding options. I think the key message from our point of view and the work we've been doing and our team have been doing with our clients is proactivity. So thinking about funding needs in advance of it being an immediate requirement tomorrow. As I said earlier, one of the main concerns we have is post-lockdown, how businesses build back up to their normalized 100% turnover levels and how that gets planned out as best possible, because it's very difficult to project, obviously. A lot of the issues around the CBIL funding, where banks have been asking for projections, of course, have been clients saying to us, how can we possibly project? We don't know what this is going to look like. Our message is, please plan as best you can for it. When that need comes, possibly Q4 2020, it might be too late to take advantage of CBIL, which is such a great opportunity, as you stated during the presentation, Kip. Before I go on to a brief overview of our CF service and how it links into the funding side, can you just possibly give your sort of insights into CBILs at the moment, how successful you've been with CBILs? Because from a lot of our client perspectives, CBIL was a really slow starter, and a lot of it was in the press. The government were blaming the banks for not getting money out quick enough. The banks were blaming the government for not having given them sufficient guidance as to the lending criteria. So we saw very much the old style government schemes, a repeat of them in terms of the difficulty of obtaining it. And there were confusion around personal guarantees and how much the bank should be taking. The government stepped in again. And that was to a certain extent released, but it wasn't really released until the bounce back loans came in. And then, as per your slide earlier, there were huge quantities of applications. And the vast majority of the government funding that's gone in, or the government back funding, reiterate, it's not government funds, is it really? But the vast majority of the funding that's gone out under these schemes is BBLs, not CBILs. So I just wanted your take on how you were looking upon CBILs right now, and specifically around lots of our clients think there are significant restrictions as to what they can use the money for, and obviously how they display the need for that funding. And I just wondered whether you could perhaps give a little bit of guidance around that in terms of the criteria.
Yeah, absolutely. So yeah, like you said, Paul, it got off to a very, very slow start. If people are aware, it was basically a change in name from what was previously the Enterprise Finance Guarantee, which was the previous scheme that was put in place by the government to support businesses on an unsecured basis. So it was dominated by the high street banks. They weren't able to do it quick enough. They were still doing their full underwriting, and because it was a new product process, they really didn't understand it, quite frankly. So at that point, I can understand, obviously, that's when most clients put in the CBILS applications, and I can imagine a huge majority have still been put off by that. At that point, there were only about 15 active lenders under the scheme. There are now over 100. So it's really important to understand and note that that marketplace is now really, really open. There are a huge number of lenders willing to support, up to 250, up to 500,000 in the alternative marketplace. You're going to get responses within 24, 48 hours. It's that quick. You do not need a huge amount of information. The most of them just need your last full set of accounts, details of the director shareholders, last 6 months bank statements, and an understanding of the impact of COVID. That, generally speaking, is it in order to get an indicative offer. You just need to make sure it's a viable business, and what we mean by that is it must have been profit making in 2019, and the key caveat within it is the 2019 turnover. You're allowed debt up to 25% of that turnover. That really is it in a nutshell. And within CBILS at Capitalise, we've seen it across absolutely every single product sector. So we've seen it across secured, we've seen it across invoice finance, we've seen it across revolving credit facilities, term loans, asset finance, every single type of product and lender and client, we've been able to support. So if you are worried about it in that respect, if you think it's going to take too much time, if you think it's too difficult, it really isn't. It is really worth looking into. If you do need funding, like I say, this is a once in a lifetime opportunity, and we've only got 4 weeks left to actually get the application in. So I really wouldn't delay. I'd certainly recommend having a look at it, speaking to Hallidays, and seeing what funding you really need moving forward.
Great, thanks for that, Kit. So just a brief overview of Hallidays CF. Our entire service offering at Hallidays is based around a client's aspirations, goals, vision, mission. We spun it, as we said from the very beginning, from our main service being around growth. COVID changed that a little bit. Everybody was taking stock of their business, wondering how they were going to cope with the whole lockdown. Some businesses went down to zero turnover, as has been reported in the press extensively. Some were just reduced, but there were very difficult business operational issues almost across the board. Only a handful of clients really were able to grow during the COVID period. So things changed a bit to more of a support role, mainly around cash flows, planning, structural stuff, as we've alluded to before. But all of our service offering is based around understanding a client's goals, vision, and mission. In terms of funding, we see it as being a journey. So we start very much about understanding where people are going with from early start companies. Strategic growth plans are key. Early start businesses, some of them will require some angel funding. Early start businesses without a couple of years trading won't be able to go for the sort of debt funding that we're talking about with Capitalise. So we do an awful lot of planning. We run Stockport Business Angels event, that's our event. We joint with solicitors and wealth management firms, run Cheshire Business Angels, and we have a range of high net worth investors who can help with that early stage seed investment. Debt funding very much comes into the Capitalise realm that we've just discussed with Kip just then. Huge range of funding sources available as Kip's gone through. For further step change growth, we also do quite a lot with private equity and venture capital, mainly private equity in the Manchester area, but we've dealt with 3 or 4 major private equity VC funds in London on some of the larger deals. But Manchester these days is more than capable of handling most PE deals for step changes for businesses. And then a lot of our M&A activity is based around a client's requirements for a share sale. That could be management buyouts. We do an awful lot in management buyout area because we deal with SME, owner-managed businesses. A lot of them have management tiers who have aspirations to take over that business, and we do a lot of vendor-initiated MBOs, which I'll refer to in a little bit more detail on another slide. Because we deal with the SME owner-managed client base, quite often corporate finance doesn't come across their bows too often. So one of our main aims is to demystify the surface. There's a lot of corporate finance boutiques who consider it to be a bit of a dark art. We very much would say it isn't. It's very simple. What we aim to do is maximise the value to the shareholders. So a major part of that is funding, the second part of what corporate finance includes below on this slide. So the sources of funding and capital structure of businesses are key to what we do. And this is why relationships such as the one with Capitalise are really key. What we aim to do is build an efficient balance sheet, that can drive that business forwards to whatever that business owner wishes to achieve with that. And it's all about strategy. It's all about strategic, proactive planning for what they aim to achieve, those business owners and directors. Just a couple of brief examples. This is very much referencing the journey we were talking about on the earlier slide. So this chap, watching his son playing alone in the garden, invented what at that time was eye control iFlick. It's now called Football Flick. Many of you might have seen it it's available in Argos, Costco, JD Sports, Amazon. It's now a global product, so it's gone across to the States and into the Far East. So it's been a huge success story. We dealt with the seed EIS funding and EIS funding for it, so the real initial funding, and then we later dealt with some debt funding for this client to grow through an invoice finance facility. So that was a real success story from us from start to a successful large trading business. Disbridge Inn, again, many of you have probably heard of the product. We dealt with early stage funding on this as well. We've dealt with an invoice finance solution again that enabled some real growth, as it says on the slide, 1,500% in just 1 year. All the way through to Jenny Campbell's investment on Dragon's Den. So it's another one that we're very proud of from a growth story perspective. Just touch a little bit about VIMBOs, vendor-initiated MBOs. Lots of our clients have management teams, as I said, that have aspirations to take over businesses. One of the main parts of an MBO is funding it, so getting sufficient cash into the business to transact an MBO, to get cash out to the exiting shareholder. So again, quite often there are hybrid debt fund sources that go in, sometimes PE backed, but most of the time internally generated debt funding to transact. We do a huge number of MBOs, and lots of our clients look towards planning MBO transactions for years in advance of a transaction actually happening. This is our MBO training program, which we've successfully carried out with a number of our MBO clients, where we effectively help to train the management team into the position of being able to do an MBO, and we also help the exiting shareholders to structure the transaction in the most tax efficient and financially efficient manner, which leaves the business viable moving forwards for the MBO team, and also helps the exiting shareholder with their requirements to leave into retirement. Just a bit more generically about holidays, we're very proud of our client ratings. We survey our clients quarterly. That support and growth has spun in what was for us Q4 2020, so the period to May. COVID has meant we very much focused on the support rather than growth. Normally we get those scores sort of leveling off, but lots of clients were very intrinsically focused on keeping their business stable during that period, and we repositioned accordingly. But again, yeah, we're very transparent about our client operations and scores. This is our contacts. Many of you will have the contacts of myself and our marketing team, but that's my email address and our main number. Hopefully you've got a feel today for our sort of approach to our clients and our approach to this COVID period in terms of assessment of clients' needs and funding requirements through this period. Before we just go on to a Q&A, I'd just like to thank again Kit and Kaylee for your time on the presentation. Some questions. We answered one before, Kit, about CBILS and how effectively disappointing the early stages of that would be. And you talked a little bit about the restrictions around CBIL usage. Can you just clarify it is okay to get CBIL funding for the likes of a transaction and acquisition, because that does provide some uncertainty for clients?
Yeah, absolutely. As long as the debt itself is being lent to an existing trading business that had been operating in 2019, then absolutely, the debt can be used for pretty much any purpose. So it can be used for an acquisition, MBO, whatever it might be. It certainly can be. Some banks are a little bit more restrictive in terms of what they can allow, but generally speaking, the alternative marketplace, which is now where the vast majority of CBILS lendings actually takes place, they are more than happy for the purpose to be acquisitions, MBOs, like I said. So if you are looking for sort of those transactional type deals for funding, and you've thought in the past that maybe it wasn't allowed under the actual scheme itself, it is. So again, I wouldn't let any reason for the funding stop you from applying.
Thanks, Kit. Ryan's just put a question in. Do you expect the scheme to be extended beyond this end of September for applications?
Yes, so I think it was going to be a bit touch and go as to whether it was going to be extended. The extension itself has taken place, so whilst the applications still need to be in by the 30th of September, the new change that came into place a couple of weeks ago is that lenders now have until the 30th of November to actually draw those funds. So you just need to make sure you get the initial inquiry in by the end of September, even if you don't have maybe all the documentation ready, the information. As long as you get that initial inquiry in by the 30th of September, you then have a 2-month period to work through the application to get the funding drawn. I think given we've already had that come through in the marketplace and an announcement from the government, I'd be surprised if they suddenly did change it and actually extend the scheme. However, that being said, the government right now are doing quite a few U-turns, so it's going to be quite hard to fully predict, but I don't actually think it will be formally extended.
Thanks, Kit. And another question, can you elaborate a little bit on the personal guarantee required for CBIL?
Yeah, absolutely. So no personal guarantee required whatsoever for a loan under 250,000. So just to clarify that exactly, if you were to take 3 loans of 250,000 across 3 different lenders, you would not have to provide a personal guarantee at all. Again, if you took 3 loans across 3 separate products, so term loan, revolving credit facility, asset finance, for example, you again wouldn't have to provide a personal guarantee. The only time you have to provide a personal guarantee is if you're going to take a single facility over 250,000. And at that point, you have to provide up to, it's obviously at lender's discretion, but they're going to want you to provide the maximum, a 20% personal guarantee of the entire debt amount. So that is the exact personal guarantee requirements for CBILS.
Thanks, Kit. Just a question into me about how we might handle together between Holidays and Capitalise a transaction where a client might be looking for, say, £500,000 and they've been talking to their bank about some property finance or some invoice finance, different sources. Just to clarify that we are capable of putting together a hybrid facility. In the old school days, you'd expect a bank manager to put that sort of facility together for a client, wouldn't you? But now it's not quite that way. So just to clarify that you do see those lends where a client has a requirement and we put a package together that goes across a range of security.
Yeah, absolutely. Yeah, you can do it across a multitude of different lenders. It can be with one lender, but if need be, you can do a product with each lender, and that's why obviously it helps with Capitalise having those relationships with different lenders. But yeah, it's certainly doable in the marketplace, those sort of deals now.
Thanks, Kit. If you guys have got any further questions, then please do direct them to myself or Dan or any of the central numbers, and we'll loop in. And if we need Kip and Kaylee to answer those, we'll get those answers back to you as soon as possible. Again, thanks everybody for attending this morning. I know time is valuable, especially right now. As it says on screen, feedback is a gift. If you could please complete the feedback form, it would be much appreciated. Just a reminder that our next webinar is the first in our series of Business AM, presented by my co-director Nicola Coles. That's Tuesday the 29th of September. And again, webinar format as COVID is dictating these days. We'd love to have you in the building as the previous programs have been, but unfortunately we're still restricted right now, and we're not quite sure when that will change. So if you're interested in that, which is about setting goals, which was mentioned earlier in this webinar about our core service, please feel free to book in at the Holidays website. Okay, thanks everybody. Thanks for your time.